Hello everyone, and thanks for joining me in Fundamental Signals. Today I'm going to talk about SPGI, S&P Global. Now, I'm not talking about the index, but I'm talking about the company who's behind the index, provide analytics and all that for the commodity market and a financial market worldwide. So, SPGI is a ticker, and I think based on many indicators, SPGI is undervalued at this moment. Um, Looking back at the history of SPGI and looking at the revenue momentum oscillator, which basically again um, shows if the price is ahead of revenue or revenue is ahead of price and which one is lagging, we can see the price is lagging behind the revenue growth. Now, throughout the history, whenever the lag was there was an opportunity. So looking back from 1988, we see every single time the price is lagging behind the revenue growth, we have a dip in the price, and that used to be a good time to buy. So here, for example, in 1988, we see that we have a signal, and then after that, the price goes up. Again, in 1991, 1990, we have this dip in the price, and then we got this green signal, and then after that the price grow. And as you can see, every single time we had that, here, 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 and here, for example, we have these major or minor pullbacks, which after that it was a big run upside. Now, the problem or something to consider when you look at this indicator is that this lag can stay for a long time. And an example is from 2008 to 2009. And you can see here the price topped here, and we start seeing this indicator being green, meaning the revenue was there, but market was not seeing it for some reason, and then the price kept going down. So you need to be aware of that when you look at this indicator, but that again only shows you that the opportunity you should find the opportunity there. You need to look for it, and then that's where it was in 2008, where it was in 2022 2023 period, and we can see that was basically the bottom, and then we went higher. Right now we have that signal again, and if we zoom in, we can see we had a big drop in price recently to $408, and we've been there for some time now. So the revenue is coming, is growing, but the price diverges from the revenue. That's signal number one, why I think it's undervalued. Signal number two is P to E ratio comparison. So this P to E ratio comparison basically divides historical P to E to forward P to E. Now, historical is the last year P to E ratio, the average of that, and the current price divided by forward earnings in the next year. And that forward is basically obviously estimated earnings in the future. Whenever the forward P to E is less than historical P to E. So whenever the forward P to E is less than historical P to E, then we get this spike in these indicators. What it means is that people do not see the future as that valuable as history. But after that, the forward P to E catches up, the price catches up, and then we have a run to the upside. Now, looking at this indicator and looking at the history and what if you basically DCA, whenever this P to E ratio, the comparison was above 1.1, meaning the forward P to E is discounted 10% or more, and you just DCA into this stock and then exit, when it goes below 0.9, meaning the forward P2E is 10% more expensive than the historical P2E, then you sell it. So if you trade this setup, on average you would gain 42%, but you had to wait 532 days on average for this setup to play out. And we can see there would be a time that you would lose money, between 5 to 15% or 0 to 5%, around basically 12% of times you would lose, but the rest you would win more than 15%. So odds are in your favor if you trade this setup. Now, where are we right now? Where we are right now is this P to E ratio. If we can zoom in, if that comparison sits at 1.26 at this moment, 1.20, yes, 27. So it means the forward P2E is 27% cheaper or discounted compared to the historical P2E. And that historically, as we saw here, based on the stats, was a good time to DCA into stock, to start buying it. So that was signal number 2. And lastly, I want to show this another signal, which is dividend yield. Now, the indicator doesn't show directly the dividend yield. It shows the differences between current dividend yield and last 2 years. So when this indicator goes above point, above 1, uh, that basically is when you have lower P2E, lower dividend yield compared to the last 2 years. And that's usually when you see buyers come in and buy this stock. So you can see these spikes correspond to these pullbacks in the price, right? So here we have another one here, here. Again, same as all the other indicators. It could stay there for a long time. It could, price might go lower, but it's just there to show you that this SPGI has a lot of opportunities in it. So you need to look for opportunities. You can also combine your technical analysis with these analysis and then start buying into the stock, start DCing, and wait for it to play out. All right. I hope you like the content. Please give this video a thumbs up and subscribe to my channel. I'll see you next time. Bye.